We're seeing weakness in not just in the oil price this morning, but across others, nickel, iron ore, and the oil price, of course. Does this give you pause for concern, reason to question any parts of your strategy, or is it sort of onwards and upwards?
No, quite the opposite, actually. I would say it reconfirms what we've been thinking. 2 points I'd make on this. One is our view has been that commodity prices are due to correct lower, particularly in the oil sector. I think we've been a little bit surprised in some way that oil has risen so much, particularly when you talk about supply agreements, particularly not being adhered to. And I hear you mention that about 10 minutes ago on the show. So our view is that oversupply will continue to be an issue in the oil market, and we expect prices to come back. So no surprise here whatsoever from that perspective. Secondly, talking about global growth and China, we'd be less concerned about that. In fact, we would suggest that global growth continues to be very strong. Our economics team can continually focus on the upside surprises we're seeing in growth, and refer back to the aircraft orders we've just seen. Super strong, and certainly a strong vote of confidence that global growth is holding up very well.
Yeah, don't forget we had the Boeing order, I believe just yesterday, which was a $15 billion order for the big Dreamliners. A lot of other commodities go into obviously making these products. While I can understand your thinking on oil, what about the rest of the commodity sector? I mean, nickel is a big loser as well today, but we see other metals, non-precious metals falling. Does it make sense to you that commodities should fall across the board? Because that seems to be based on concern about China and global growth, which the numbers look good.
Well, I would agree with you, and I think it's probably a little bit surprising in that sense if the market is trying to highlight that the reason commodity prices are off, if it's linked to this China downturn. We would tend to push back against that, and we would actually highlight that actually China's shown remarkable resilience this year, and in some ways an improvement relative to quite low expectations at the beginning of the year. So I think from our perspective, we would look much more at the supply and demand characteristics in commodity markets, which, as we said, we think excess supply is the issue here, rather than being too concerned about a slowdown in global growth.
Not so concerned about a slowdown in global growth. Of course, we're going to get the CPI number out of the United States later on today. What's front and foremost for you in the US at the moment? Is it the jobs? Is it the tax debate? Goldman Sachs saying overnight that things are moving faster than they'd expected. Some of their former colleagues, perhaps, managing to push things through. But the first quarter of 2018, they now see the chance of a deal up at 80%. It was at 65%. What are your expectations around tax, and how much does it matter?
Well, look, I think this is really important, and I think there's a big opportunity here in markets. So it's exactly what we're thinking. Our US economists expect a fiscal boost next year coming from tax reform. In fact, the latest numbers we have is in addition to growth of 0.6%, or 0.6 percentage points. That gives us a pretty strong growth number next year as far as the US is concerned. Now, an interesting point to focus on here, however, is if you look at the recent Fed minutes, the Fed is not anticipating a boost from fiscal stimulus or tax reform. So therefore, it's not priced into their calculations. So
three's not enough next year?
I think this could be the point. If we're right and we do get tax reform coming through, that could have an impact on US or on Fed rate hike expectations, pushing US yields higher and pushing the dollar higher as well. And these are trades we're very much focused on as a house that we think will do well, particularly as we click over into 2018.
Stephen, it's absolutely fascinating, really, to watch this and to consider the effects that real tax reform or any decent, especially on the corporate side, tax reform would have in regards to the Fed's dot plot and so on. But I wonder, in the shorter term, there's a possibility, again, in December of a government shutdown. How do you hedge against that kind of risk? Because it could be a real problem for U.S. stocks at the levels they are, still fairly highly priced.
Sure. Well, this is something that comes up quite often, almost on an annual basis. And I think the market tends to dismiss it, tends to think it will be a negotiating tactic, it will go down to the line, but ultimately things will be okay. I think from our perspective, that's probably the base case scenario. To answer your question very specifically, how do you hedge against it? Well, it may be if investors focus much more on the tax reform. That's something that's not likely to come through until 2018. So it may mean that those trade recommendations we're talking about, US yields higher, the dollar higher, it may be that will take until 2018 to really come in, particularly if the tax reforms are likely to prove the catalyst for those trades working.